Good afternoon, everyone. Today we are going to look at IS 28 investment in associates. This is part of the group accounts. IS 28 defines an associate as an entity over which the investor has significant influence. That is neither a subsidiary nor an interest in joint venture. So IS 28 guides the accounting treatment of an associate, and that is an entity we are saying that is an entity where you find an investor has significant influence. And what is significant influence? Significant influence is the power to participate in the financial operating policy decisions of the investee, but which is not control or joint control. So significant influence you find you have where you find you the investor is having power to participate in both the operating and financial decisions of the investee, then it means that very investor has significant influence. It normally comes about, whenever an investor holds more than 20% of the voting rights, of the investee. So where you find the investor is holding more than 20%, that is, it is having a shareholding of 21% up to 30%, then it means that very investor has significant influence in the investee. Significant influence can also be demonstrated in the following ways. We have other ways how significant influence can be demonstrated. We can show significant influence using the following. One, where the investor represents on the board of directors of the investee, you find you have the investors, maybe board members of the investor, they are part of the board of the investee. That one is an obvious demonstration that the investor has significant influence. Two, participation in the policy making decision. This one we have talked about it. Policy making decisions, that is both financial and operating decisions. Then it means the investor has significant influence. Three, where you find the investor has material transactions between the investor, where you find there are material transactions between the investor and the investee, that one is also a demonstration. Last, interchange of management personnel, interchanging management personnel. The investors' personnel can do work in the investors' personnel, most especially the management. Management people. So when you find management people of the investor can be switched off, can switch to work or to do some form of management, in the investee, or even vice versa. Or even vice versa. From the investee to investor, then that is a demonstration that the investor has significant influence. Let's look at how we account for associates. Associates are accounted for by what we call equity method of accounting. Equity method of accounting is the accounting method that is used to account associates. Now, this is a method of accounting whereby the investment in associate is initially recorded at cost and adjusted thereafter for the post-acquisition changes in the investor's share of net assets of the associate. Net assets of the associate here we mean the assets and liabilities. So the change in net assets, of course, the change in net assets will also be represented by the profits that have actually been made during the period, during the year. So if we are saying to measure the value of investment in associate, you get the cost, the initial cost, you add the post-acquisition changes, then it means you are adding, for example, the share of the investors, yeah, the investors share in the post-acquisition profits of the associate. If the associate during the period has made like 20 million, you get the price at the beginning that was paid to acquire the associate shares, then you add the percentage of the profits, that is 20 million, the associate has made over the period. We shall look at how that one is done. Let's look at this. This is what we have actually talked about. The carrying amount of the investment in associate is computed as cost plus group share of retained post-acquisition profits less any impairment losses. What does that mean? This means that I beg, I request that I do just something here, because seems there is something that is that is not clear. Let me first adjust this one. Just a minute. Okay. The effect of this is that the comprehensive statement of financial position includes 100% of the assets of the assets and liabilities. This one is liabilities. Yeah, 100% of the assets, 100% of the assets and liabilities of the parent and subsidiary company on a line-by-line basis. So the consolidated statement of financial position, remember when we are consolidating, you add line-by-line assets and liabilities, 100% of the parent and what? And the subsidiary. Then, after that, you have to come up with an investment in associate line within non-current assets. Yeah. So after the property, plant, and equipment that is in non-current assets, then you will add an investment in associate, because an investment in associate is a non-current asset. So you put an online of an investment in associate. Yeah. Which includes the group share of the assets and liabilities of the associate. So we have seen how we computed it up there. Then the consolidated income statement will include 100% of the incomes and expenses of the parent and subsidiary company on a line-by-line basis. Yes. So when we are consolidating the income statement, add 100% incomes and expenses. That one we shall look at it at a later point. But let's first finish this IAS 28. So we are saying that line by line for income statement, income and expenses. But for the associate, you also create a known line for share of profit of associate in the income statement. And this will include the group share of any associate profit after tax. So if you have profits made by the associate during that period, then the group or the parent will have a share. So that is the share you are creating a line for in the income statement. Okay. The associate is included in non-current as a non-current asset investment and is calculated as below. So this is what I was talking about. Get your cost of investment, add share of post-acquisition profits, less impairment losses. Impairment losses, this one you arrive at it after you computed goodwill. So you need to compute goodwill, have come up with impairment losses. Otherwise, you will not get impairment losses if you have not computed goodwill in the associate. Then less provision for unrealized profits if you have transaction between the parent and what? And the associate. Then what you get is the value of the associate. Okay, we proceed. Proceed. The group share of the associates post-acquisition profits or losses and the impairment of goodwill will also be included in the group retained earnings calculation. So here what we mean that The group share for subdivision profits, of course, will also go to group retained earnings. Yeah, for the purposes of balance sheet. We are preparing what? Yeah, balance sheet. Then the impairment will also go to the goodwill. So that is how we come up with the investment in what? In associate. We have an example, but I want us to just be off for like 1 minute, just 1 minute, then we come, we do this, the example, we have just 1 minute. 1 minute break, then we come, we do this very example.